Welcome to the On the Tape podcast. I'm Guy Adami. I'm joined, as always, by Elizabeth Young. That, of course, is EY of SoFi. Elizabeth, how are you?
Buenos dias. I am wonderful. Happy Monday to you and everybody listening.
To you as well. Today, by the way, later on, we're going to be joined by Tom James. He's the CEO and CIO and co-founder of Trade Flow. That's a fascinating conversation that Dan and I had, so stick around. By the way, Art Delacruz this Friday, a special drop of the On the Tape podcast from Team Rubicon, and we have a special giveaway on the back of that, so stay tuned. Elizabeth, that's all the housekeeping. Let's talk about the markets, because I will tell you, once again, I find myself Thursday and Friday of last week on the very confused side of the equation.
Yes, it was maybe not the direction that we would have expected immediately, but I don't know that it's entirely confusing yet. I think there's relief, and we've talked about this a little bit. Yields come down, the yield curve is re-steepening. There's relief that now the Fed is all but confirmed done with this hiking cycle. They just can't really say that they're done with the hiking cycle. So the immediate interpretation, the knee-jerk reaction is, oh, thank goodness, it might be done, right? It might be over. They're not going to constrict any further. But I think what we haven't seen yet, and I'm not saying that it's wrong or right to say that this is a new uptrend or that this is a bear market rally, but that's where the debate is now. We don't know the answer to either of those things. If it is a new uptrend, what we need to see is things that will confirm that. So things like high beta outperforming low beta, discretionary outperforming staples. You need to see breadth that continues to strengthen for multiple days in a row. Now, we did see some strong breadth last week. And what I mean by that is the advance versus decline in the S&P. But we're still at a point where only 44% of the S&P is trading above its 200-day moving average. So we don't have confirmation yet. I think that last week was a relief rally. I'm not going to call it a bear market rally, but I do think that there was a lot of relief in it. And I don't know that that should be entirely surprising after the few months that we've had.
No, fair enough. Again, it's interesting that the interpretation of bad news, and it has been a series of negative data that's come across, ISM data, the jobs data, which, by the way, now 8 months of revisions lower. So clearly, the jobs picture is deteriorating right before our very eyes, yet market participants seemingly are championing that. And to your point about the Fed, and I know you know this as well, but it's important to point out, I agree. And quite frankly, I don't even know if it matters at this point what the Fed does in terms of hiking, not hiking. The damage has been done, and it's manifesting itself in the data. So the fact that the market, or whatever participants in the market, whatever algorithms are out there, are interpreting this as good news is sort of odd to me, because as job market deteriorates, almost by definition, the consumer is going to be weakened, which is 73% of the economy, which by definition means things start to slow down. So I think your point is well taken. I understand, I guess, what we saw last week, and I think it was a bit of a relief rally. But I think if the market really woke up and saw what was going on, I don't think they'd be nearly as joyous as they seem to be right now.
Yeah, well, so here's where we're at right now. And if I'm the Fed, not that they're going to necessarily say something like this, but we've all sort of sat back and said, okay, now just let the clock run. We have to sit back and see what happens. We have to see how all of these hikes start to feed through the system. We have to see all of the pipeline that still has not come through. I mentioned this, I think, last week. We seem to forget that we did 4 75 basis point hikes in a row. That is fast and furious. And then we had another 150 basis points of hikes after that. So all of that stuff has not come through the pipeline yet. The other thing that I think market participants need to ask themselves is, if you're on the side of thinking, okay, the Fed is done, that's good, yields came down, that's good, this has the markings of a new rally or a durable uptrend, you have to ask yourself, why are they done? Why would they be done hiking? If your answer to that is because inflation is coming down, okay, but then the market should have reacted like this the last time that we had inflation data. And that's not what happened. The market started reacting like this when we started to get weaker economic data. And Friday's economic data confirmed that weaker economic data. And the idea that the unemployment rate is still below 4%, yes, signals health, and yes, signals that we still have a tight jobs market, but it's been rising at a pretty steady rate. And if you look over history, which I know is a guide, not a rule, if you look over history, when you see that little turn up in the unemployment rate, it starts very slowly, but then it goes up very quickly. And it usually happens when you get certain readings. So the now readings that become higher than the averages. So whether it's a 12-month moving average or a 3-year moving average, you get those readings that start to tick above the averages, and we're right on the cusp of that happening. So it's danger zone time, and still not confirmed in either direction. But I think that a lot of the assumption about the Fed being done has more to do with the fact that the economy is cooling rather than things needing to come back down to neutral and us being in a really, really healthy spot.
No, that's a fair point, and it's interesting you mentioned what you're saying is that move in jobs is going to be nonlinear, and I agree with that. It starts to tick higher, and I think the hope is it ticks higher in a sort of very controlled fashion, and we get to a level that everybody's comfortable with, and then it stops. The problem, of course, is the same way the Fed thought they could control inflation, which clearly they could not, because on this November 7th or whatever date today is, it's clearly still a problem. Is I think the same way they think they can control the labor market, which they cannot, because once that thing starts to cascade, once that genie's out of the bottle, I think you're going to get to 4.5% to 5% a lot faster than people think. And I'm not sure the market's going to enjoy that as much as it seemingly thinks it will right now.
Well, I think there's going to be a mental threshold. And for whatever reason, I feel like that mental threshold is probably about 4.5%. So I think we're probably still comfortable with it as investors as the unemployment rate gets to 4 and then the low 4s. Somewhere around 4.5%, I imagine people will get a little uncomfortable and say, okay, that's enough. That's good. Let's reverse directions or stop. But that, as you mentioned, the Fed doesn't make that decision. Companies are making those decisions, and companies are making those decisions on the heels of the capital constriction that's been going on and their revenue line dropping because inflation is dropping. So the Fed cannot control that whatsoever. The only way that the Fed might be able to affect that is to pump liquidity into the system. And we obviously can't do that until inflation is solved. The other point I want to make, and we talked about this on Market Call on Thursday, and Dan made me even clarify it so that it would be totally clear to our audience. I said on Thursday after the Fed meeting that I think the Fed is going to have to cut rates long before the market thinks they're going to. At that point, the market was pricing in the first cut in July of next year, maybe decidedly later, September-ish, but July of next year was the first cut. On Friday, after the jobs data came out, after we saw some cooling in those numbers, that first cut got pulled forward now almost 2 months. We've got a 66% chance priced in of a cut in May of next year, 100% chance of a cut priced in June. So we pulled it forward already 1.5 or 2 months, depending on how you look at that. And I don't think that is a surprise either. It might even get pulled forward faster as the data continues to cool. So I think those cuts too, you have to ask yourself, why would they be cutting? Would they be cutting because things are cooling? So if the reaction to Friday's data was that they are going to cut sooner, I don't think that is a positive sentiment.
It's interesting you say that. The bulls will say we want to get ahead of those cuts because those cuts will suggest a mission accomplished type of thing where everything is fallen into place. The unemployment rate has gone higher, but not markedly so. We still have significant growth. Inflation is cooling. All the things that we wanted to happen were going to happen. We saw no credit event. The stock market's hanging in there. And that's the bull case, that if you're going to see a cut in May, it's because everything is coming up roses. I'm hard pressed to, and I understand what you're saying. The data suggests exactly that. I'm hard pressed to understand an environment where if they're cutting in May, inflation is under control. I don't see there's any, given what I'm seeing right now, this sort of reacceleration in things, I'm hard pressed to understand how the inflation portion of this equation is going to be under control. I mean, everything I don't think can sort of line up for them by spring of next year.
I don't think so either. Look, stranger things have happened. The concept here is much like the one that we've talked about ad nauseum about the yield curve. It's not the inversion that gets you, it's the re-steepening. In this case, it's not the first set of hikes that gets you, it's actually the cuts. And if you look at the market reaction in between, sometimes there is a pretty strong rally in between the last hike and the first cut because people are excited that it's over, excited that the hiking cycle is over. But once you get to that cut, it is very, very difficult, except for maybe in the 90s. There is not really a good example of a time when the Fed started cutting rates and it was a good reaction in the market afterwards, because they usually have to cut in response to data that has now become too cool or so soft that now they're trying to save it rather than get in front of it. And look, we can sit here and criticize the Fed and say, oh, they're always wrong. They always do it too late. They always do it too far. That may be the case. The reality is the data that they're dealing with is always backward looking. So they can't really do it exactly at the right time unless somehow they have superpowers and some kind of premonition to know exactly what's going on. So there's a lot of inconsistencies. There's a lot of inaccuracies in some of the data, and the fact that the timing is tough. The last thing I'll say is a lot of the data that we talk about, and I point to it too, it's survey data. So you're asking companies or you're asking consumers how they're feeling, right? Or what their sense is of what's going on either in their own home, in the job market, in the orders market, right? You've got a lot of small business sentiment surveys. These are just surveys. It's people responding with their opinions and their feelings about what's going on. It's not always hard data. So this is a really tricky thing to get right.
It's interesting. Jacob and Amanda have just come up with the title of this podcast. And I don't know if you're a Rod Stewart fan. Are you? I actually have seen Rod Stewart a number of times.
That surprises me.
Yeah. Well, I will say, Rod Stewart in his day was a member of the band Faces. Ronnie Wood was in that band. They were a rock and roll band. He's gone sort of more the Sinatra, Tony Bennett route in his later life, but that's neither here nor there, because one of his hit songs is "The First Cut is the Deepest." And Jacob and Amanda have decided that's the title for this podcast. And I agree. That first cut, when and if it happens, is going to be fascinating to watch. So excellent job by them. There's the next question for you is, I struggle with this. People ask me about this. I'm sure you get it as well. Are you being dogmatic in your views, or, do you still believe all the things that you talk about? And the answer is, yes, I do. And I understand that dogma thing. I mentioned that because Mike Wilson, obviously, I'm going to read a couple things from Morgan Stanley. He basically is warning that the gains that we're seeing are a bear market rally, which, by the way, I happen to agree with. Citing a gloomy earnings outlook, weaker macro data, and we've been talking about that, and deteriorating analyst views, quote, "We find it difficult to get more excited about a year-end rally," he added, noting that a gain looks more like a bear market rally rather than the start of a sustained upswing. Quote, "The drop in Treasury yields was more related to the lower than expected coupon issuance and guidance and weaker economic data, as opposed to the bullish interpretation for equities that the Fed is going to cut rates earlier next year." So he's saying a lot of the things that we're saying. I respect his work. I know you do as well. And I happen to agree. I think Treasury sort of bailed us out a little bit last week when they pulled back on some of the issuances, but that doesn't mean they're just sort of basically playing a waiting game. They're going to try to do short-term. At a certain point, they're going to have to pull the trigger, because their hope is that rates come down and they can somehow thread that needle of the issuance that still has to come out with a debt of now $33 trillion or so, Elizabeth.
Yeah. So I think the 30,000 foot debate was the correction in 2022 the one that we needed? Did that solve it? And I always think about the sequence. You have the market goes first, earnings go next, economy last. If that was the checking the box of the market goes first. So we had that drawdown, we had the bear market. It was kind of cute. It was like a cute little bear, but we had it. And then earnings, we've had now 3 quarters consecutively of negative earnings growth. So if that was the earnings box that we checked, okay, done. Now the last one that we need to check is the economy. It's started, as in inflation has come down. We've seen some cooling in the data. We've got really some cruddy PMI data that continues to come in. We've got really jumpy consumer confidence because people aren't sure how they should feel about it. But the other parts of the economy, like GDP growth, we obviously just saw a really hot third quarter, but that is not expected to continue. So GDP growth, inflation continuing to come down, we need that to happen. And we've got now this labor thing that we're watching. And I think everybody can agree that it's cooling, and we're watching it with a really keen eye to see how quickly it cools. So now we wait and see if this is just the economic slowing that we've been waiting to check the box on. That would confirm that that was the only bear market we needed in 2022. The other side of the debate, which it sounds like this might be where Mike is, this is the part that I worry about, is that 2022 wasn't enough. That was somewhat of a repricing because assets had gotten so overbought. 2022 wasn't quite enough because it also didn't have a recession, and you rarely see the market bottom before the recession. So if that was the bottom, then it was absent a recession, which, okay, maybe this is one of the first times that we reset the business cycle without a recession. But the concern is that it wasn't enough, and we still have to see a bigger one and a bigger reset. And that's what we're waiting to find out. Bear market rallies are usually, if not always, very ferocious. They're tricky because they lead everybody to believe that they're real and that they're durable. Last week was a pretty ferocious rally. We had a day of a 500-point up day in the Dow, right? We haven't seen that in a very long time. So it was a ferocious rally. It was a ferocious rally across the indexes. But there were some places that didn't participate, or there were some spots that did participate that aren't sending durable rally signals. Things like gold going up so strongly. Small caps did go up a little bit, but they didn't necessarily get out of the woods. So you want to see some of those confirmations, much like what I mentioned earlier in the podcast. You want to see high beta versus low. You want to see discretionary versus staples. You don't want to see gold going up so strongly. So I just don't think we have confirmation yet that we're out of the woods and that 2022 was the only correction we needed.
Yeah, listen, I agree with you. I think 2022 is a bit of a tremor ahead of what could be a larger earthquake. But, a lot of people say we've dodged a bullet here. I will tell you, on the good side of the equation, on the credit side of things, there was a period of time a couple of weeks ago where the HYG, the high yield credit ETF, looked like it was going to roll over either side of 72. That has bounced pretty significantly for that. So the credit market is telling you, we don't see any worries here. Again, it's going to be interesting to see how they dodge that bullet, given some of the volatility we're seeing in interest rates. And this is from now the head of research at BlackRock. The question we ask, if surge in rates has fed through to equities, our answer is not yet. That's basically what you're saying. We think there's more downward adjustment to come, but we expect to see better environment in 2024 once the adjustment is complete. Okay. The equity team, the research team there said he expects global growth to stagnate over the coming year as the U.S. economy is weaker than it appears. I would agree with that. And equities don't reflect the higher rate environment we see persisting. If it turns out that we're wrong and there's a material pickup in economic growth or sustained pullback in rates, maybe we'll change our course. So rates going lower, again, it goes back to how we started this. People are championing that, but I don't think they fully understand the magnitude. First of all, 50 basis points from 5% to 4.5% over 5 or 6 trading days is as historic as some of the moves that we saw to the upside. And the bond volatility is still here in spades. That's not going away. So if you think it's going to be clear sailing now for the next 6 months, I think you're wrong. And I think some of that obviously is what BlackRock is trying to say in that note.
Yes. The other thing that I would ask myself, and I do ask myself, is some of the other stress that we've been talking about, things like delinquencies ticking up. You've got credit card debt at really, really high levels. The delinquencies ticking up and the issues that we're seeing are some of the cracks that we're seeing in that consumer credit part of the market. Is it only because rates were high? And I think the answer to that is no. That added onto it. That was fuel to the fire. But it's because people started to overspend, and then they continued to overspend, drain down the savings, and then they were trying to make ends meet. Rates being so high added to the strain on their wallets, as did inflation, as did gas prices, you name it. But it's not just because rates were high. I say that because then if you're thinking about it intellectually, you have to be consistent. If it's good that rates are coming down, then if that was the only problem, it should solve all of these other issues. It should make consumers stop being delinquent. It should lower delinquencies. It should reduce all of the issues that we've been talking about. Credit card debt should come down. I'm not convinced that that's going to be the case. I think that we're seeing the beginning of some of this stress. And I say that also because you mentioned spreads. You're right. The high yield market, the investment grade market has not shown signs of stress. We haven't gotten anywhere near what crisis levels of spreads have seen before. Maybe we won't, but I don't think that we know that for sure yet. And the activity in small caps tie that into this. The activity in small caps and the weakness in small caps, the reason that they've gotten hit so hard is because small cap companies generally cannot internally finance their growth. They have to go to debt markets, they have to go to equity markets. So weakness that we've seen in the market in small caps could just be a premonition saying that we will eventually see a blowout in spreads, because as that debt starts to roll over, or as there are companies that cannot meet those obligations, then it starts to hit the bond market. Maybe it hasn't happened yet, maybe it won't happen, but I think that the warning is there in the equity market.
I'm glad you said that you have to be intellectually honest. You do. I mean, you can't, and a lot of people do this, you completely dismiss rates going higher as a function of whatever. It's not a big deal. It's not a big deal. And then when rates go markedly lower, say that's the salve for everything. And the fact that, the all clear sign is now being shown brightly on the New York City skyline. You can't have it both ways. It's both or it's neither. And again, bond volatility to me is still just a tell that there's stress on the system. And the bond, it's interesting that the equity market seems so certain of something, yet the bond market seems so uncertain. And as you know, the bond market's a lot bigger. Savita Subramanian from Bank of America, we follow her very closely. She turned bullish a few months ago, and good for her. But in a tweet she put out, the economy is cooling, but companies have had their earnings recession. They've cut costs and are now enjoying margin expansion. I understand about the cost cutting, but cost cutting comes in the form of laying people off. And to a large extent, you're going to see more of that. I'm not certain about the margin expansion part. Like I've seen it sort of around the edges, but I haven't seen enough to believe that we're going to start to see margin expansion. I think that ship sailed a long time ago.
Yeah, I'm guessing she's talking about the expectation of margin expansion. Next year we've got expectations still of 12% earnings growth, but only 6% revenue growth by mathematical ways. That does say that there's somehow margins are expanding, but it also says that costs need to be cut further. This is a really nuanced take, but I think this is what we're going to start to see. And we did actually see it in one of the Magnificent Seven stocks this time around. During earnings seasons going forward, I think companies are going to be rewarded much more if they beat or meet based solely on cost cutting. So if the commentary is, we cut our costs, we trimmed the fat, therefore we meet expectations or we beat expectations, I think there's a reward for that. That is not really a positive sentiment. That's not something that is creating sustainable growth going forward. That's still companies saying, okay, we're cutting. So we're being good stewards of capital by not overspending. But to your point, at some level, that cutting starts to bleed into the employment picture. Companies have cut labor in the tech sector, and that didn't really upset anyone. That happened last year, end of the year before, beginning of this year. That didn't upset anyone because they were already inflated. I think if you start to hear that across the board from other companies, there was actually a shipping company a few days ago that made an announcement of a lot of cuts. Right. So you start to hear that in industrials, you start to hear that in cyclicals. If that bleeds through, that starts to get contagious just from a sentiment standpoint, and cost cutting becomes a bad thing. But I think for a little while, we're gonna see companies get rewarded for cutting costs.
We'll put it in the show notes, but the comments out of the CEO of Maersk were alarming. 3,500. I think they've already cut 6,500 jobs. They're anticipating another 3,500. And I'm paraphrasing, but basically saying 2024 looks dire. And you're talking about one of the largest shipping companies, if not the largest shipping company in the world. And when they make comments like that, again, you can't dismiss it. And people say that I cherry pick. I understand that. I try to look at all the different things, but to just dismiss that out of hand, I think is foolish. This week is fascinating. Here's what we have today. Now, by the time this comes out, it might have already happened, but a Fed governor, Lisa Cook, speaks today. Michael Barr, he's a Fed vice chair for supervision, speaks tomorrow. Christopher Waller speaks tomorrow. Lisa Cook speaks again on Wednesday. Jerome Powell speaking on Wednesday. Michael Barr again on Wednesday. Fed Vice Chair Philip Jefferson speaks on Wednesday. And Jerome Powell speaking, I believe, at an IMF event on Thursday. Fed speak all over the place. So it's going to be interesting to hear if they speak with a common voice, or if you get some of the divergences we've seen before. So although it looks like a quiet week, there are a lot of things still to be watching, I think.
Absolutely. That's a lot of speakers. And we've seen it before where we've got a break in meetings. There's not a whole lot going on from a data perspective. The market is searching for a reason to do something. And this could be one of those weeks where you've got a statement by someone that sends things in one direction or another. It'll also be interesting to hear their take now that we have that jobs data from Friday. We haven't really heard from the Fed since that data came out. It'll be interesting to hear what they say, if they change their tune at all, or if there's any nuances in the language that they use, particularly Jerome Powell, if there's any nuances in that, the language that might confirm that they are done hiking, or if they're going to continue to be much more hawkish, which I think they've actually tried over and over again to sound hawkish. The market just doesn't entirely believe it. So it'll be interesting to hear if there's a tone shift this week as a result of the labor data.
No, I agree with you. It's going to be, again, the market obviously hangs on their every word, and tone is important. But right now, it seems as though the market is saying these guys and gals have gotten it right. And in fact, as we get to the seasonality, which I'm not a huge believer in, but there are a lot of people that believe November historically is a decent month into December. If we start to see quiet markets tend to levitate in the absence of bad news. So we'll just see if that continues. I, for one, am hard pressed to believe that it is. And we talked, Danny and I, and Dan, you've brought it up. What's going on in Japan is still front and center. Dollar yen traded north of 151 last week. It's pulled back a little bit, but the alarm bells are clearly going off there. You've seen what's going on in their 10 years. The JGBs have gone to levels we haven't seen in many, many years. The currency weakness is a problem, and that does not cure itself overnight either. So as much as there's to like in terms of the S&P 500 at 4370, there's just as much to be leery of in terms of what we're seeing in some of these other developed economies.
Yep. And one of the fallacies that you can fall into is everything's fine in my house, and it doesn't matter that other people's houses are not looking good. It does matter, and it matters in ways that maybe isn't obvious to investors on their day-to-day basis, but it does matter under the surface, and it matters for all of the leverage that is out there, that carry trade of Japanese yen that has not necessarily come home to roost yet. But if there's a lot of movement in the currency market, it will. And rates moving like they have, that risk is clear, and it's out there, and it's out there in a big way. So the idea that, okay, but my house is intact, other houses might be falling down around me, but I'm okay, it is all connected. And financial markets will continue to have impact and reverberate around the globe, particularly the big ones. It's one thing when it's a really small market in an emerging nation that doesn't necessarily have ties or that isn't big enough to affect others. But the Japanese market is big enough to affect others. So it's not something that we can ignore.
Not a lot on the earnings front this week. We have Disney, I believe, Wednesday after the bell. Obviously, that's always fun to watch. Stock is not obviously traded particularly well. Something I'll be watching tomorrow, DHI, obviously a home builder. I think they're before the market tomorrow. It's interesting. Home builders, that line of demarcation, and I know you don't want to play stock market here, neither do I, but what I will say is it appears as though once we breach 4.5 to the upside, obviously a while ago, that's when home builders started to take notice and the stock sold off. Obviously, when we got to 5% in the 10-year, that was probably the trough for a lot of those stocks. Those stocks have rebounded on yields coming back down. The supply-demand imbalances still exist. They have not gone away, but it's going to be fascinating to see, for me at least, how the market interprets this move in yields in terms of what they want to do with sort of that space, Elizabeth, if that makes sense.
Yes. And the housing data, you can go through my Twitter feed. I have a couple tweets about this. Housing data is very delayed, particularly home price data. It's usually about 2 months behind. So we saw that big spike in mortgage rates in September, October-ish, the 8% level, but we haven't seen data that was happening at the same time in prices yet. So we have to wait for it. It's very, very lagged. The housing market also doesn't react as quickly as some of the other data does. Some of it even has a 1-year lag. So you've got, if supply is going up in the market trying to take care of that imbalance, you don't have a reaction in home prices typically until a year later, a year after supply has increased. So that's a picture that, again, has been confounding, I think, for economists, and the market kind of chopped around in the midst of it. But it's been a theory that, oh, well, the housing market should cool, of course, because mortgage rates have gone up so much. I'm pretty convinced that it will cool. It just hasn't happened yet. And because we've got people refusing to move, which they should, it's not the best financial decision to move if you don't have to. But because there just hasn't been as much activity, it's difficult to figure out what's actually going on. So I think that lagged effect too, which is separate, that lagged effect will start to come through in 2024.